Welcome to my channel. I'm going to show you step by step how to value a stock. Together we will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. The company we're going to look at is Alliance Data Systems. This company provides private label credit cards to companies like Victoria's Secret, J. Crew, Eddie Bauer, Pottery Barn, and Pier 1 Imports. Let's get started with the model. This company has a market cap of $2.2 billion. So that's the value of the company according to the stock market. They're trading at $46.15, so that's one share of stock, $46. And now let's pull the free cash flow. And the way you value a company is you estimate the future free cash flows and then discount that back to today's value. Let's pull their actual free cash flows and put that into the model. And it looks like they have positive, healthy free cash flows, over $1 billion every year. It's a lot of cash to work with. Net income we're getting next, which is the profit and loss on the income statement. And then we're going to pull the revenue, which are the sales, which is also on the income statement. And you can see their sales have dropped quite a bit in 2019. That's not good to see when investing in a company. They were over $7 billion a year for 3 straight years, then dropped to $5.5 billion. So hopefully that trend doesn't continue. Let's look at the capital structure of the company. The interest expense is $569 million. That's the interest they pay in their debt. Let's go to the balance sheet to see how much debt they have. We'll go to the liability section. And the current debt is $3.1 billion. That's debt due within 12 months. Long-term debt is $7 billion. That's debt due after 12 months. Let's get their effective tax rate since interest payments are tax deductible. The income before tax is $700 million. The income tax is $165 million. So the effective tax rate is 22%. So the cost of debt is the interest rate on the debt, 5.6% times 1 minus the effective tax rate. That comes out to 4.35%. To get the cost of equity, we need the beta. The beta is how volatile a stock is relative to the market. So the entire market has a beta of 1. And this has a beta of 2.49. So the stock moves 2.5 times the market. So that's not necessarily a good thing because it's more risky, the stock. So when you invest in a risky stock, you expect a higher return. Let's go back to the balance sheet, get their current assets. This is $24 billion. We need to calculate the current ratio later, so we need current assets, and that consists of $3.8 billion of cash, $450 million in net receivables, $218 million in inventory, and $268 million of other current assets. We also need the current liabilities to calculate the current ratio. That's $11.8 billion. Let's see what that is. That's $3.1 billion of current debt, $300 million of accounts payable. This is how much money the company owes its creditors and suppliers over the next 12 months. Accrued liabilities of $309 million. So when a company incurs an expense, if it doesn't pay it right away, it books it onto accrued liabilities. And eventually it will pay it, and when it does, it takes it out of accrued liabilities. Payroll and payroll taxes are a common type of accrued liability. Deferred revenue is $7.7 billion. This is when a company receives revenue in advance of delivering a product or service, and it books it as deferred revenue. When it actually delivers a product or service, it takes it out of deferred revenue and books it onto the income statement as revenue. Other current liabilities of $338 million. Let's look at their stockholders' equity. That's $1.6 billion. That's total assets minus total liabilities. And we need this number to calculate the price to book ratio and the ROE. Let's see what that is. That's 1.1 million of common stock, 5.2 billion of retained earnings. Retained earnings is all the prior income the company received minus all its dividends it paid out. So all the income it has to grow its business or pay down debt. They have negative 100 million of accumulated other comprehensive income. These are unrealized losses on securities it hasn't yet sold, so it hasn't realized the losses yet. Let's go back to the income statement and get their operating income. That's how much money the company makes on its operational business. That's $1.4 billion. Let's look at a capital structure. Cost of debt is 4.35%. Weight of debt is 86%. Cost of equity is 21%. Weight of equity is 14%. So the WACC is 6.7%, which is a blend of the cost of debt and cost of equity. That's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value of $2.5 billion. That's all cash flows after year 4. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company at $6.1 billion. We divide that by 48 million shares, we get an intrinsic stock price of $129. They're trading at 46, so they're trading at a 64% discount. So it's a strong buy according to the model. Let's see what Simply Wall Street says. They're at $81. They're also saying that the company's undervalued, just not as much as me. Why is the company so undervalued? Why don't people just buy it if it's worth $128? Well, because their revenue is declining probably, and people are concerned it's going to keep happening. This $128 is based off of the prior financial information. It's based off of $7 billion of revenue. If they don't keep this up, if I change these numbers to $5 billion or $4 billion, then you'll see it's a lot closer to where they're trading at. You can see they were trading way higher. They were up to like 3.25 a few years back, and they've been dropping. So it seems like a really good value. It's really hard to predict this stuff. We got to see how the company performs over the next year or two. If it continues declining, then maybe it's going to eventually go out of business. Let's look at the financial ratios to get more information. They have a good PE, a good price to sales, and a good price to book. When your stock price goes down so much, your ratios look really good because the numerator is stock price. PE is stock price over earnings per share. To get earnings per share, that's net income over shares outstanding. They have a ratio of 8. I like to see below 15. This indicates investors are willing to pay $8 for $1 of earnings. Price to sales is stock price over sales per share. Sales per share is revenue over shares outstanding. I like to see below 2.5. They're at 0.4. So investors are willing to pay 40 cents for $1 of revenue. Price to book is stock price over book value per share. To get book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 1.4. This indicates investors are willing to pay $1.40 for $1 book value. All really good ratios. They have a good current ratio, good interest coverage ratio, and a decent ROE. Current ratio is current assets over current liabilities, so they can easily cover their current debts and payables. ROE is net income over equity, so they provide a pretty decent return to the equity holders. Interest coverage ratio is EBIT over interest expense, so they can cover their interest expense 2.4 times. I like to see above 2, so they're doing okay here. The best way to look at ratios is to compare them to similar companies. I've done videos on American Express, Camping World, MasterCard, PayPal, and Visa, all in the same industry as Alliance. And if Alliance has a number in green, they're better than the average. If they're in red, they're worse than the average. So they have the best PE of all the companies. They have a really good price to sales compared to the average, and they have the best price to book and best current ratio of the companies. Their ROE is below average. They have the second most debt behind Camping World, which is 100% debt. And their market cap is really small. They're only at $2.2 billion compared to 4 companies at over $100 billion market cap. It can be risky investing in a company that's in a decline, but you're getting good value, so you have to weigh those options. Thanks for watching.